Hey, everybody, welcome. Episode 3, Bullshit
Hello.
and Mining. Mark Turner over there, Kai Hoffman right here. And we're going to talk about balance sheets today. And the super exciting topic here. And exactly. But it's going to be super helpful because we think balance sheets is one way to understand junior mining companies. And you brought a couple examples that we're going to run through. And what's your main source? Where do you find the balance sheets, the data that you're looking for in general?
Well, on CEDAR, on the SEC, on the company website, just the quarterly financials. You pull them down.
CEDAR, the website of the 90s. So it's so great. But I think we should dive right in because you prepared an example, and I'm going to switch over here the scene as well. So people are going to see you, and they're going to see the graphic that you brought, and we're going to start with the operating profit of the said company.
Okay, fine. So the idea of this is to show just one company and just to look out for the kind of things I'm looking for in a balance sheet, to see if it's a weak balance sheet or a strong balance sheet. The example here is, how do you pronounce it, Kai? Amerigo here. How do you pronounce it?
Amerigo.
Amerigo, okay. Amerigo Resources, ARG. And it's a really nice, clear example because they have a very weak balance sheet. And right now you can see it. You can see it a mile away. So here, the first chart here is not balance sheet. It is, in fact, the operating profit, what they've been doing at the mine. And you can see, like, in 17 and 18, they were doing okay, making off profits. For one reason or another, in 2019, they hit problems and they have been making either small profits or losses, or operating losses. That is a scenario. Okay. Now, when you have a situation like that, if a company has a strong balance sheet, its equity or its share price will survive better. If it has a weak balance sheet, it could be in serious trouble. And that's why I want to show you this example, ARG, today, because it's now in trouble. So let's go down. Let's move on. This is the first. Okay, so you've got slide 2 up there.
Yeah, we got cash and short-term liabilities up.
Yeah, okay, so cash and short-term liabilities, they've always had about, you see, the 17, 18, and even in 2019, they always like $15, $20 million of cash, and this is US dollars, by the way. They were like $15, $20 million. So plenty of liquidity, no problems at all. And they've always, like just like any other company, they'll want you to look and say, oh, okay, we've got this cash in treasury. Our treasury position is 15 million. Our treasury position is 16.4 million. I mean, even in the second quarter of 2019 here, they were making sure that we knew that they had cash of 8.4 before the next slide. Can we move to the next slide? Because the next slide is what we really should be looking at. Not necessarily cash, working capital. And here you can see working capital in ARG has been weak for a long time and is now very weak. They've got this big working capital deficiency, and this quarter just came out this week has underscored that. Okay, so that's about it. I don't want to spend too long on these charts. I mean, the next one, for example, is debt, and it shows it's actually liabilities, but it shows the relationship of the debt of the company with the total liabilities of the company, and some of the breakdown. And I don't want to spend too long on these, but I look at this one, and then if you look at the next one, the fifth one, I'll look at book value and see that, and then with the sixth one, this is the book. This compares the book value per share, which right now is 68 cents. I mean, there we know that there's something wrong, because if the company's books are telling you the share is worth 68 cents, and right now, today, it closes at like 19 cents or 20 cents, something's wrong. Yeah?
There's a huge discrepancy for sure. Yeah.
Okay. So that's all I want to talk about with those charts, but except for two things. One, we're going to leave them there on the podcast, yeah? So people can have a better look at them in their own time.
They're going to be up on the screen here, so they can just scroll back and forth on the video. So.
Right. And two, the main point I want to mention here is the way that the charts present the balance sheet information. I mean, a lot of people don't like these kind of things because they look at a balance sheet and it's just a whole bunch of numbers. No. So what I do is when the quarterly comes in or when the annual comes in, I'll put the numbers into my Excel, compare them to the company, and I get this visual reply, and it's much easier to get a feel of what's going on with the company over time. So that's why I do it that way. And these are the kind of charts I do in the weekly all the time.
Yeah, because companies, and I've noticed that's one of my pet peeves, is they don't do a good job at reporting that, sometimes on purpose, because they compare quarters, or they show quarters in the press release, like they realized 100% gain on something, versus a quarter that doesn't make any sense, maybe versus a quarter that was a non-production quarter, right? So, and that just jumps out when you visualize it like that. So
yeah, it's for me more than anything else. I mean, it's the way it just makes it easier.
Yeah.
It's a visual thing. So anyway. So that's the whole point. That's the whole point.
Yeah. Now, you want to talk about the share price development as well, and sort of the impact of the various events over the last 2 years on the share price, and yes. How you handle that situation yourself.
Okay, so have you got slide 7 up? Because I think this is the last one I want to do. Yeah.
Yeah, exactly.
Because ironically, even with America having a weak balance sheet and knowing a weak balance sheet, I bought the stock. Yeah. And not only that, I lost money. Yeah. And I want to explain why. So here's the 2-year price chart of AIG, and I bought in September 2018, just where that number 1 arrow is. And I actually bought a couple of times, and my cost average was 91 cents. Tell you that.
Yeah.
And then it did what it did, and then around about arrow number 2, that's when it came out with some bad news. It had a couple of pieces of bad news. One was not its fault, and the other one actually turned out to be its fault. We didn't know at the time. And the stock got hit, and it went down to that. You see that range in number 3, and that range carried on last year. 2019, it bounced between, let's say, 50 and let's say 75. Yeah. Yeah. And I held through. And at this point, I was underwater. I was cost average 91 cents, and I was underwater. And I knew it was a weak balance sheet as well. But I also knew that if they executed on on their plans, and as long as the copper price was correct, and they did what they said they were going to do, they would have enough money to pay down the debt, and the equity would improve. So I held through. Then number 4 came along. Number 4 was third quarter of 2019, and I sold. I sold that day.
Were you responsible for that massive drop then, huh?
No, I wasn't. No. They were responsible for that massive drop. No shareholder was responsible for that massive drop. Yeah. The company was responsible for that massive drop. Okay. Again, let's not go into too many details, but it became clear that they had problems, and this is where it does matter. Yeah. This is where. I mean, it's actually number 4 and number 5 on this price chart that matter the most, because I took my loss. I sold at 50 cents, and then so I lost 41 cents per share on 91 cents. So it was a hefty percentage loss plus my commission. It was my worst trade of 2019. Yeah. And it was my worst trade of 2019. I lost money, and it was a big position as well. And so number 4 and number 5 is what it's all about, because once you know that the company's in trouble, if the company's got a weak balance sheet, it's not coming back. That isn't the bottom. And number 5, what we saw today, and what we saw, I mean, you can see where it dipped from around about 50 to around. It got caught up in the crash, obviously, but it also had its own bad annuals. And now today, I actually put the footnote of its financials on the blog. It is not a going concern. Well, let's put it this way: it's doubtful if it's a going concern anymore, because of this weak balance sheet situation. I mean, they've also tried to refinance it. They refinanced all that debt in the third quarter of 2019, but now it's just too heavy.
Just doesn't work anymore. Yeah. And
so the moral of the story is when number 4 happened, it's time to get out. Take your loss. Say goodbye. Sorry, sometimes you lose. Because when your company's got a weak balance sheet, number 5 happens. And if it's got a decent balance sheet, it can get its way back, and number 5 doesn't necessarily happen.
No, that makes sense. And
that's the end of my story for today. Now it's your turn.
No, and that was a long story, and I really appreciate that. And like one key takeaway I got here is really the visualization of those numbers that they put in those balance sheets for you. Like you can be your own.
Doing them in the chart form. Yeah, I do. So it's the way I work.
Yeah, no, but like I think it's a good, like I try to do that myself, and sometimes it's really tedious work because it's just impossible sometimes to get the proper data. It's not really presented in a way that it makes sense, especially on smaller companies. They just present it in a way they want to. Okay.
Tedious is my fun. You know my idea of fun is like 10:45 on a Friday night is like one by one putting these data points into.
Yeah, watching I'd be watching a Netflix series doing that actually. It's like that's kind of the busy work I like to do, watching Netflix and stuff like that. So I brought an example as well that I want to talk about, and it doesn't mention a company, and it doesn't really matter because the point is the same. And I just switched over. It's a balance sheet, and I've talked about that in January 2019 already. When you look at a balance sheet, and you can't see it right now, but I think I sent the slide to you via WhatsApp. The point is the company has $213,000 in cash, and then a promissory notes outstanding of over $18 million. Okay, and that part, accounts payable is $1.4 million, derivative liabilities is $300,000. That company has total liabilities of over $20 million versus assets of $255,000. Okay,
yeah, we're just looking at this. Okay, here we go. Okay, got it.
So, and I've circled that. And that is super easy to find. Actually, we talked about last week, we talked about Friday night press releases. Look at the companies that are raising $200,000, $300,000. Look at their balance sheets, especially if you want to play that game. And that's where you find those gems. I think that was actually a Friday night find. When I was looking at a $200,000 financing, just looked at a little more detail. And the company needs to raise $20 million just to break even and just put a black zero back on the balance sheet. It's ridiculous. And those are easy to spot, though, if you put in the effort, right?
And I noticed that I choose one that filed today, and you choose one that filed in April 2017.
Yeah, because I had it, because I knew where to find it preparing for this. Because I'm not going to go into it. It's okay. And despite how much money we've been raising in the last few weeks here, it's a drop in the bucket for many, and it doesn't move the needle for the grassroots companies. So that is one of the examples that I brought.
Because you're in this, how much uptick have you seen in placements financings in Vancouver? Let's say last 2 weeks, 3 weeks.
The last 2 weeks were tremendous. They were fantastic. We've seen large financings. We've seen Silvercrest, $128 million in total. Orla for $75. Just this week, we've seen a lot. I haven't looked at the day to day yet, and I'm really looking forward to the index coming out this week because it should be a new record, in my opinion, the last 12 months.
What about all the little billy ones?
So we looked at the ones that below $10 million financings. They're suffering and dropped off massively in April. While the big ones, they sort of blur the image or the picture in general. They blurred a bit, or not just a bit, they blurred massively, right? The Bluestone financing, the Silvercrest one that I mentioned, Orla, those big ones, they just completely destroy average size and all of that stuff. But it's been good. Like we've seen Ely Gold raise $10 million, and there were many others this week that came out. Marathon Gold, $30 million. I can't even come up with them all more. Like it was... A while ago, you could easily come up with one per week that was somewhat mentionable, right?
But it's still a case of the rich get richer and the poor get poorer because there's nothing down there at the bottom of the food chain. Yeah?
Exactly. Like one thing that always puzzling me, like people tell me, oh, you got to back management teams. But what happens if they started how are you going to get a new management team going down at the bottom? It's a different story. We talked about the working capital. That's really a big thing. Like reporting and timelines, we addressed it sort of in the chart setup that you create, which I personally like a lot, and that's why I like reading your weekly as well. But also the working capital deficiencies. That was my example, and we're going to come to a couple of questions by the Twitter community here, and I'm going to switch over here, and let's see if I can get it up on screen here. Yes, one is from Nick Avery, and he's asking. It's all,
Who's Nick? Who's that?
Nicholas Avery.
Nicholas Avery, okay.
Farming on Twitter. And I think you're familiar with, you actually know him. And cheap loans to directors, okay or not okay?
Bellows son, yeah? I was talking just this morning with a friend of mine and thinking, which company can we use as a simple example? And my friend said, what do you do, Bellows son? And I was like, no, God, I mean... No, let's do balance sheet 101 before we get to 405, and all the kind of scams and dirty deals inside that company are terrible. Cheap loans to directors are not okay, Nick. They are not okay. Good question.
Under any circumstance, nope.
Under any circumstances, not good. Not good at all. Put your own private. Isn't it cool? Yeah.
Zebra Breed is asking, and that's showing up here on the screen as well. Like, what is your opinion?
I do know CB. I know CB.
Yeah, I met him actually at PDAC, so a really good guy, geotechnical engineer. Please correct me if I'm wrong. From Spain, so phenomenal guy. What is both your opinion on the sense, nonsense of dividends and buybacks in this cyclical sector? When is it justified? When a red flag?
You.
Okay. A junior should never buy back. A junior exploration company should never buy back shares. Dividends, once you've established and you've hit your growth potential, then I think it's okay to pay dividends. Even before then, and no. Unless, it depends on the business plan about dividends. I'm not going to shut that out. Buybacks for junior exploration or even junior mining company, I think is risky and doesn't send the wrong message. I think we're in a growth industry and I want to see growth. So that's my 2 cents.
Are there junior exploration companies that do buybacks? I've never even heard of it.
I've seen it.
And it would be stupid. But anyway, fine.
Yeah.
And buybacks for miners. The thing with buybacks is if they've got nothing else to do with the money, then yes. Okay, so if it's a junior miner and it hasn't got anything else to do with the money, I'm not going to be owning it anyway.
Yeah. Well, it's sort of like Amazon. Like I haven't even looked at Amazon in ages, but it's a growth company. They always invest in new technologies, like to grow. Like
yes, until total world domination. It's very simple. I mean, you want to talk about balance sheet? Talk about Amazon now. No, there's a really good example of a company that doesn't give a damn about its bottom line, and it's all about asset expansion.
Yeah.
It's exactly the example. I mean, that's a really good example of balance sheets.
Yeah. Let's talk about what companies, that's a question I'm posing. Like, what are companies hiding in their balance sheets? Well, you talked about the working capital deficiencies. That's an obvious one. But are there things that are being hidden in a balance sheet? What should people be looking for on a first glance?
My head exploded. What's hidden in the balance sheet?
Well, let's talk about, we talked about IRA, marketing costs. I like how sometimes costs between marketing and travel are split. So,
I mean, yeah. Again, that depends on accountancy standards, and here we have a problem in Canada again because they don't really demand much transparency from quarterlies or annuals or your AIF, which you like. It's more a case of you have to use the information you're given. I mean, that's it. I mean, you might want more, and you may demand more, and you can go and stand outside the SEC with a placard and demand more, but you're only going to get this much. So you make do with what you get. If you see my point, what you do try to do is interpret it as much as possible and understand how certain tricks and certain things that they're hiding are, the way that it happens. And you're just looking out for red flags all the time. It's red flag spotting. I'm always looking for a reason not to invest. Yeah. That's the thing.
No, I think that's the right approach, and I'm German. I always do that anyway, so I'm always negative first before I look at things in a positive way, right? Oh, come on. I'm German. I could say it. We had those questions. That one we had answered. So TV is asking on Twitter: exploration properties are liabilities, not assets, and exploration expenses are sunk funds, not assets.
Yes. If your exploration property is active and you're adding value to it and you're doing something like Eric Fier at Silvercrest, for example, then he's wrong. But if it's the moose pasture, then yeah, those things are liabilities. Absolutely. They shouldn't. I mean, they're left on the books at $1 million, $2 million, $25 million, whatever $1 million. But they are in practical terms worthless, and they are paying for their upkeep. That is a liability definition of.
Yeah. Now, one thing I've noticed,
and costing you money.
and one thing I've noticed in balance sheets for some companies, like the exploration or the value of the exploration asset actually increases without any work being done the quarter before. Have you?
Magic.
They're counting magic, right? That's a red flag for me. So, like, what are you hiding on the other side of the balance sheet, right? That you're making up over there. So.
It's not necessarily a red flag. What happens is that at the beginning of a junior miners company's life, they'll decide, where do we put the VP exploration salary? And some people put it there, and some people put it there, but some people will expense it, and some people will even capitalize it if you're in a development stage. And it could be the CEO, it could be the VPX, it could be whatever. No. And as long as the junior is going swimmingly and there's funds and there's liquidity, you don't notice these things. But then when the tide goes out, you see the skeleton, you see the bones, and suddenly you see this click, absolutely nothing happened and $250,000 got added. Why? Click. Same thing happened again next quarter. Then you notice it. You notice it when the tie's gone up.
No, good point. Good point. I've been saving one for last. Exactly. At Mining Stocks is asking, thoughts on paying services through holding companies owned by management? And do you think junior mining CEO salaries are too high?
The first one is a valid method. People, I mean, it's one person's idea of a tax loophole is another person's idea of a tax criminal. I am not going there, but these certain service companies in certain countries give tax advantages to executives, and they use them, and they're legal, and that's fine. I don't care. No worries. But they can be abused. I mean, that system can be abused. But I do understand that the structure is no problem, and I know a lot of decent, upstanding directors who use it.
Yeah.
No worries.
As long as it's reasonable, I think, right?
Yeah, salaries are too high. Depends on the company.
Okay.
Depends on the company.
Cool. Any last words? I think we're hitting our time limit. We're trying to keep it a little snappier this time. Any last words on balance sheets that you want our listeners to take away from this?
No, I want to go home.
Okay, perfect. Same here. It's beer o'clock, so awesome. Mark, until next time. Hasta mañana.
All opinions expressed by the program participants are solely their current opinions and do not reflect the opinions of SOAR Financial, their respective parent companies or affiliates, or the companies with which the program participants are affiliated, and may have been previously disseminated by them. The program participants' opinions are based upon information they consider reliable, but neither SOAR Financial nor its affiliates, nor the companies with which such participants are affiliated, warrant its completeness or accuracy, and it should not be relied upon as such. Past performance is not indicative of future results. Neither the program participants nor SOAR Financial guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on the program. Strategies or investments discussed may fluctuate in price or value. Investments or strategies mentioned in this program may not be suitable for you, and you should make your own independent decision regarding them. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You should strongly consider seeking advice from your own investment advisor. Do your own due diligence.